Okay, hello everybody, and welcome to this week's edition of Self Wealth Live, the technical analysis edition. We're here this week again. Jason, how are you going?
Hey, Rog, I am good. I'm good. Good to be back on the show for another week of charts.
Fantastic. All right. Well, look, I want to say thanks for everyone for coming today. Say hello on the chat. Don't forget to say hello, especially all our long-time listeners. It's fantastic that you keep on coming week on, week out. It's getting colder here in Victoria, Jace. What's the weather like up there in sunny New South Wales?
Yeah, it's cold. It's the sun's broken through, but we've had a couple of weeks of unpleasant cloudiness and rain, and comes with the season, doesn't it?
Comes with the season. I hope this is not going to be the same in the stock markets, even though they seem to be all-time highs. All the headlines are hitting all-time highs at the moment. So, let's hope it doesn't become a winter very soon with the stock market. So before we get going today, don't forget, guys, today's a session around analyzing the markets from a technical analysis perspective. If you've never been before, obviously, if you want to put in your tickers, put them in. If you've got some general questions for us around the subject of technical analysis, then feel free to chuck those questions in as well. And we're here to help. It's just another general session. All right. So before we go ahead, Jason, do you want to put up the disclaimers?
Yeah, so everything today is general commentary only. So nothing we say is personal advice. It's general only. And I'm just going to quickly put up this on the screen. And that just outlines that. And also it explains that I'm not part of Self Wealth. My business is Motion Trader. So you can see all my licensing details in that top disclaimer. And then one beneath that is the Self Wealth disclaimer, all the licensing details for Self Wealth there as well. So as I say, general commentary only.
Okay, fantastic. Thanks, Jason. All right, so let's get straight into the market analysis today, and let's talk. What is the ASX doing currently, Jason?
Yeah, so let's get the chart up on the screen. So I've got the here's the ASX 200, and this is a really interesting point where we find the local market at the moment, and is so I think the question is this going to be like a top of the range before we get some sort of a pullback towards the moving averages, or are we about to soon see a series of all-time highs develop? I think the two key levels on this chart to keep an eye on, we've got the March high and the April low. So they kind of bound up the range the ASX 200's been in over the last month coming up to a couple of months now. So they're our reference points. And we can also add in a short-term support. So I'm just going to put a short-term support level through. Let me just draw that in now. Comes in, just see where it catches a previous low, a high, some previous lows. Comes in at around 7,720 thereabouts. Also coincides with the 50-day moving average. So on the charts I use, typically I'm always going to have the 50-day and the 100-day moving averages. They just work well for the type of analysis I like to do. So my view has been that the overall trend is up. Overall trend has been up since October. And I've also favoured a longer consolidation. So we've been in this corrective period now since early April. I've favoured it could track longer, maybe another month, even another two. That's been the sort of the tilt I've been taking. And I think while the ASX 200 remains below the March low, that still remains I think it remains a real possibility. But I'm also open to the possibility that prices run from where we currently are. I think we just need an open mind at this point with the market so close to all-time highs. Like there's a scenario where it could just break and start moving higher now. So we're really got to just wait and see. Is it going to like top of the range and pull back, or is it going to break through? As it stands, we've got a market that had been rising, pull back towards those moving averages. rallied off the averages. So that's all classic bullish price action. And I think we want, and what's been good about that, it's been like that classic buy the dip scenario where the price comes back, you get the buy the dip and it starts going up. So all that I think has been really constructive. And also just last week, we saw this little shallow consolidation. So we had that nice rally off the lows from last month, just a week, just moving sideways, tight little range, and then a break higher. So I like the way the price action is developing. It seems to be being bought every time there's a dip. One of the things I'm keeping an eye on is the financials, the financial ETF. So this is the BetaShares financials, ASX 200 financial ETF. And this was a really good guide when the rally got started last October, when the financials, they had a false break, quickly got back above their moving averages, and then we had more breakouts come in December, and everything just followed through into the ASX 200. We had that nice rally. Upward trends very much in place, but just in the short term, like there's potential for a double top to form. You can see where I got this blue overhead resistance. It's just a case for me, like I think there's further upside here. It's just a case of, does it pause around that previous high from March? Give us a bit of a double top, maybe back to the moving averages, maybe then a rally. So for me, I like the look of the markets. I think it's a timing thing. I think the strategy here, I think it's twofold. Firstly, it's about minimizing risk. So we're always using those stop losses, and if the stock's moving higher, it's a trailing stop. And I like to use a nice wide trailing stop as well. So if the market does happen to pull back into this range and do some more work, I've got a wide trailing stop in my stock, so that gives them room to move around. So hopefully then I can see off the consolidation. But if we do get a situation where the market does rally, well, then I'm still in my positions, I'm still holding, so I benefit from a rally. But then if the worst case scenario happens and the whole thing breaks down, which I'm not anticipating, I don't see any signs of that at the moment. But if that were to happen, this is where it's all about managing risk. I do have an exit level if the market does come back. So really, I've got a plan for all scenarios, up, sideways, and down. I think it's really important that we do have that thought process across all the stocks in our portfolios. And then the second part of my plan involves buying, and that's what I'm doing now. I'm looking for stocks that are breaking higher, breaking out of ranges, rallying off moving averages. I think that's where the risk-reward setups are the best. And just all about trading with that momentum and using those stop loss in case the momentum stalls.
Yeah, fair enough. Is it a similar picture, just while we're on the Australian market, is a similar picture in the All Ordinaries as well, or?
Pretty much. Just click over to that. It's the All Ordinaries. Look, it does look quite similar to the ASX 200, top of the range at the moment. It's like, do we pull back into the range, or do we break to the top side? It's really, I could see it going either way. Either way wouldn't be a surprise. So I think we just need those strategies for being able to play both sides of that. If it pulls back, we have a plan to just to be managing our risk. And if it runs, well, it's great. We're in the market. We're in positions. We can let them run.
Yeah, fantastic. And just for our viewers, obviously, I know a lot of us are all about technical analysis and. Yeah, and the share market, we're probably pretty experienced in what some of these things mean. But just quickly, Jason, what's the difference in the ASX 200 index and the All Ordinaries index?
So the ASX 200 is the top 200 companies, and the All Ordinaries is the top 500 companies. So it just has a greater range of companies within it. I think a company needs to have a market cap of about $100 million to make it into the top 500. It's rough, about 100 million. I'm not sure where it is for the ASX 200. It might be around $2 billion. So there's quite a difference in the size of the lower end of both of those both of those indices. But the main drivers of both the ASX 200 and the All Ordinaries, it's that top 10, like the BHP, Rio, the banks. They really do have the greatest influence across both the All Ords and the ASX 200.
Yeah, fantastic. And just quickly, Jason, when you say how do they measure 2 million, 2 billion, whatever it is? How's that measured? The size of the company,
It will be the share price times by the number of outstanding shares.
All right, fantastic.
So that'll give us the market cap. So if there's if there's a million shares on offer and each share is worth $1, it's going to have a market cap of $1 million. So for a simple example, and that'll gives us what the market is valuing the entire company as.
Fantastic. That's a great explanation. Very simple, and that's what it's all about. All right, so let's have a look at the US. So it's a similar situation in the US, I'm assuming. Jason, what's that?
Yeah. So we'll jump over here. We've got the S&P 500, and again, I think it's shaping up as a pretty interesting week. So it's same question: is it a new advance underway, or is this the final push before some sort of pullback towards the moving averages? So we had a new all-time high in the S&P 500 last week. Same for the Nasdaq, and we also have a clear break above the March high. So that's all pretty positive, I think, when we see that. We've been discussing the possibility of a pullback over the last few weeks. I think that remains a possibility. There's nothing here to suggest anything other than a pullback is on the cards. It does look like an overall strong upward trending phase, and there's nothing here suggesting this market is topping. I think the question has been about how long a consolidation could last. And as I was saying, with the ASX 200, I thought a longer consolidation was likely, given the extent of the rally off the October low. But last week's break to a new high, well, I think that makes that look less likely. It does look like the momentum favours continuing to push higher. I think the play here is the same as it was last week and for the last few months, for that matter, and that's staying long, using those wide trailing stops to try and see off the consolidations. So that was a 5.5% pullback, which is pretty routine in the course of a year. We get these pullbacks in the markets. That's why I think it's important that when you're looking at your portfolios, it's like you've got to give the stocks in those portfolios room to move around, because the market is going to have these periods where it pulls back. And if every time it comes back, 3, 5 to 7%, you don't want to be getting knocked out of your best stocks, or you can never really let those gains compound over maybe a year or 2 or 3 if it's a really nice trend. So you've got to give them some room to move around to see off these consolidations that we get. And but also remember, markets are never. We've got this bit of momentum coming in now, and it's been a good 6 months. But remember, it's never a one-way street. Always other things to consider, and we're always managing risk. It's not just about thinking, look, how much could we make if the market keeps running? You've got to always think about managing risk. What has been interesting is, so we've got these new all-time highs in the S&P 500 and the Nasdaq. But when I look at the equal weight versions, so this is the market capitalization. So this is where the biggest stocks have the biggest influence. But then if we look at an equal weight version, so this is where, so the S&P 500 is 500 companies, but if you weight them equally, you can sometimes get a different picture. And what's interesting on the S&P 500 equal weight is that it hasn't yet made a new all-time high. So we call that it's non-confirming. It's not giving confirmation that of the S&P 500's new high. So not a huge deal on its own, but it is something to be aware of. It is, never want to be oblivious to risk. And when you have a non-confirmation, yeah, look, it's worth being aware of. I don't think it's suggesting that a major or like a bigger deal sell-off is on the way, but it just does give that possibility again that do prices need to come back towards the moving averages again, just do a little bit more work before really maybe getting going again. So I don't know. We just got to wait and see how that plays out. But I would really like to see this these equal weights, same in the Nasdaq, get up there and make new all-time highs as well.
Fair enough. Very good. All right. What about the Hong Kong market?
So Hang Seng having a bit of a pullback today, but overall it's continued to gather pace. It's actually up 22%. So you go back to this April low, that's a 22% rally in a month. So that's pretty extraordinary stuff to see a major market be able to rally that far in a month. And we've been speaking, like for a few months, we've been speaking about the building blocks of an upward trend. And this is really a case of seeing those building blocks quickly being stacked together. And it's when you get those signals and you get on board and you get those strong runs, it's terrific. And we can use the price action to try and identify these possibilities. Probably not an asymmetric entry point at the moment, given that it has run so far. It'd been quite normal now to see this come back a bit, see it do some consolidation, let these moving averages catch up. If I was long this market, I'd be staying long, seeing whether it can pull back, stabilize, and rally again. But yeah, it's probably just not an entry point at the moment. And the Chinese market, it's also been doing well. 8-month high. There's about an 8-month high this week. Rally hasn't been as strong as Hong Kong, but it's continuing to build. It's an emerging upward trend which continues to unfold. Interesting, just watching the news last night. There was another bearish news story on China about Chinese property, but it's interesting. It's like, do you invest based on what you see off the news or what you see in the price action? And for me, I'll take the price action every time. If the news is all about explaining what has happened previously, but the price action, I think, is giving us clues as to what how the news may start to evolve in the time going forward. So it's just helping us understand the possibilities better than waiting for those news stories to come on the TV or on the news feed.
Yeah, it's a good point. Obviously, trading off the charts. Generally, the charts are pricing in a lot of the news at the time anyway, right? So I think it's a good point you make, Jason. All right, let's have a look at some of the questions we've got so far. The EMAs. Did you mention which EMAs you're using?
Yeah, I use the 50 and 100 day EMAs. And look, people ask, do you use simple moving averages or exponential moving averages? I don't think it really matters a great deal. I like the EMAs in that they're a little bit more responsive to the most recent price action. But when I've done back testing, the results are comparable. They're comparable of whether I'm using EMAs or simple moving averages. It's just find one that you're comfortable with, and then just be consistent with it. So you're not just jumping between the two. Just get your setup on your charts as your default, as whether you're using SMAs or EMAs, and run with either one. Time frames, 10 and 20 days can be useful if you want to be more active, you want to get more signals, want to get in earlier. The trade-off is that you're going to get more false signals with the faster moving averages. Nothing wrong with that, because you've got risk management strategies should they not play out, but it's just going to be a more active approach. So I like the 50 and 100 for what I'm doing at the moment. You could use a 200 day as well, but then it's everything slows down again. So that nice middle spot for me is that 50 and 100 day.
Yeah. I was just thinking off the back of that question I was just thinking to myself, let's say you have, everyone has a finite amount of capital, right? We know no one has an infinite amount of capital. Could it be possible that you may have a strategy where you are starting to come to the point where you don't have much capital left to invest in, and maybe switching to a 50 and a 200 EMA so you can get less signals? I'm not sure. What do you think?
I think I'd probably prefer to do it other ways than playing around changing my moving average focus, because the moving averages I use are going to be like a core part of my process. So I don't want to adjust my process based on capital. I'd rather use things like a time exit. So if a stock has been if I bought a stock and it's just started to falter, it's started to pull back, it's trading below my entry price, it's going sideways, hasn't done much for 2 or 3 or 4 months, whatever it may be, I might have a time exit so I can rotate it out of the portfolio, bring something else in, but then stay true to my entry process, which is using the 50 and 100-day moving averages rather than shifting the moving averages out to slow the signal rate. And look, if you're getting signals that you can't follow, that's okay. There's no problem with that. If the flight deck's full, well, so be it. It's full. And if there's nothing that you need to sell, and you got the stocks which are doing well, that's great. You let them keep doing well. If you do, and this is an interesting thing, because I often hear people say, "Oh, look, I want to free up some capital, so I might sell half of my best stock, free up some capital, take some money out of that. So my best stock's up 100%, for instance. So I'm going to sell half of that and put it into something new." I'd go the other way. I'd go, well, I'm not touching my one which is up 100%, but I've got one which is down 20%, and it's been in the portfolio for 3 months. It's just not working. I'm going to turf it out before it hits my stop loss. Maybe it's down 10% or 15%. Maybe it's only down 5%, but it's had a bit of time. It's not doing much. I'm going to push it out, and I'm going to put the capital from that into something new. So it's keep your best stocks. Don't take your best stocks out of the field of play when they're working, and let them. You want to maximize our gains when something's going well. But if something's not happening, it's like, move it on, bring in something new, see how that goes. If it works out, great. If it doesn't, same process. Push it out, bring in something new. So you're constantly like turning over stocks, looking for the ones that run. When they run, keep them. When they don't, push them out.
Okay, so I'm glad I asked that question, Jason, because yes, that's what I'm going to do instead of changing my EMAs, right? So I'm glad I asked that. All right, so quick one here around, is this sort of analysis possible within the Self-Wealth platform? The quick answer is yes, it is available. The longer answer is it has its limitations, right? So Self-Wealth platform is great in terms of executing, but when you're doing technical analysis, you can do it in there. There's no doubt about it. And I'm probably not selling it that well here, but I'll just be honest with you. We use TradingView because it's a lot more powerful, and that's what Jason's been using even before he started with Self-Wealth, right? So, but you can have a play around with the advanced charting in the Self-Wealth platform, and if it does if that's all you need, then go for it. All right. So certainly you can do this kind of analysis within the Self-Wealth platform. Yes. All right. Jason, I've been meaning to ask, is your chart normal scale or logarithmic?
Yeah, I actually had that question come into me this morning. It's I use just the normal price action. It's we'll jump over the chart and I'll show you the difference it makes. So for when I'll use log charts, I'll show you when I use a log chart. So let's get the Dow. The Dow Jones. Let's put it on a weekly chart. And so you look at this and you go, oh well, look, back in the where's this back in the 80s and the 90s, there wasn't much going on. It was all pretty quiet back then. The market only got interesting in more recent times where the ranges get bigger. But of course, that's not true at all. If we move it across a bit back to those times, Well, there's plenty going on. Then it looks like the same thing. Back in the 50s, it looks all pretty sleepy, but move it along a bit and just bring it into that time range, and the whole thing comes to life again. But what happens when you put it onto a log chart? So I can do that with TradingView. So what I'm doing in TradingView, I'm clicking on the settings cog down the bottom right, and I'm going to put it on logarithmic. And you can see, let me just do that again. Now you're watching it. Let me go back to regular. And now watch it when I go onto log. And you'll see you can start seeing the price action from those earlier times better, because it's moving it into it's more percentage based in how the prices work. So those older prices are more relatable to the current price action. And let's see whether I can get this on a monthly. So yeah, so there's the Dow on the monthly. So this goes back to 1897, and you can see the market's moving around. There's the 20s boom. There's the crash, which was all part of the depression, and you can see the whole thing on the one chart using a log scale. And it's interesting, like you put in this is where the log scales are interesting, because you can see there's the COVID crash there, which was entirely unpleasant, but the Great Depression crash, that puts that into perspective. This was a whole nother series of unpleasantness and pain for everyone involved in the economy generally. And there's the 1987 crash in there. Now let's just jump back to regular, and all that disappears. You can't see it. So if I'm looking at indices over the longer term, I'll look at the log. But for most stuff, I'm looking at it on a day-to-day basis. For me, it's the regular price action is better. Yeah, I find trying to put it onto shorter term price action onto a log scale, I find it just distorts the price action the way I'm looking at it a bit. I'm used to using a regular chart for almost all of my analysis. It's just for that historical look back on longer term charts. You kind of need to have a little bit of a look at the log scale to bring some perspective to it all.
Good. I always saw that option, but I never knew what it did. I'm glad someone asked that, and you've answered it well. Thanks, Jason. All right. Quick question here around stops. Your large profits come from using a wide stop. You initially use a percentage stop at the start. When do you transfer from percentage stop to a wider stop?
It's basically as a stock is rising. I have a threshold which I use for the stop to start rising, but it's essentially the simple way to look at it is if the stock. Oh, let me just get a chart. Just one to come to mind, one which I know is an uptrend. So let me put a trailing stop on. I use the one which TradingView has, which is different to the one I use, but it's similar. Let me just set it up. Now just go into the settings, and I'm just going to change the multiply, because it's the default's on 3. It's using a multiple of 3 times the average trading range. I use a multiple of 10 to give it plenty of room. And just adjusting this a little bit to see if I can use it to make my point. It's just a little bit fiddly. But basically, it's a case of, so say the entry point is where I've got the cursor now. This one's behaving a little bit differently to what I'll do. So if that's my entry point, so let's just use this blue line I've just put in. My entry point's there. the stop loss will remain it'll remain static. It won't move. It'll be locked in position at where it was when the trade began. If the trade then starts to rise, well, then the trailing stop will then start to track it up, and it's going to use the trade's high as its reference point. So the trade's high is the key point that we need for our calculation, and then from the trade's high, we'll deduct the calculated width of the trailing stop, and that's what causes it to increase as the price goes up. Take the width of the trailing stop off the trade's high, and you'll find the trailing stop moves up with it. Then the stock starts going sideways again. You get another plateau where the trailing stop won't rise. Stock starts to rise again. Trailing stop will move up. That's how the trailing stop works and that's how you transition from the initial stop, waiting for some upward momentum. If the upward momentum kicks in, then the trailing stop kicks in. And I've just lost Rog. So we'll just see whether he can log back in a moment. And I don't think I'll see whether I can get your questions up. Okay, so I'm just trying to catch. Oh, hang on. I think Roger's just about to join back in. Here he is. We've got him back.
Sorry, go. Are we up to the next question? My apologies.
Yeah, so that's okay. I just opened up the questions and I was about to get stuck into them, but now you're back. I'll let you drive the questions.
Yeah.
We got your Rog?
Apologies for that. I don't know why, but I've just shut down and all of a sudden yeah, can you hear me?
Yep, we got you.
Can you hear me? Laptop just shut down.
Yeah, I'm like,
can you hear me? Everyone hear me? Give me a yes yes, you can hear me.
We've got you, Rod.
Yep. Okay. All right. Let's move on to there's a couple of questions in there about self-wealth. So I'll just quickly answer them, Jason, if you don't mind. And I apologize if it's a bit slow right now because it's certainly slow on my end. So if it isn't good, if it is, my apologies. All right. Does self-wealth have the ability to program a trailing stop? Currently, no. You can put in a stop loss order. And you have to edit it and amend it every time, as we've just explained around stop losses for Jason, you would have to amend that order in the platform every single time. So there's another question there actually that I saw around shorting in the international markets. I think there was. Look, it's a good question, and I don't know the answer to it. Why is it so from Michael? Why is the brokers don't allow trading the OS markets, don't allow shorting, don't allow trade? We do. When you say OS, I'm assuming overseas. Obviously, we allow trade. We've got trades, stocks, US market, and the Hong Kong markets. We don't allow shorting. I don't know the answer to that, whether it's a technical thing, whether it's a business decision, whether it's it's the complexity of shorting a stock. Currently self-wealth offers quite the simple products such as share trading. All right, but obviously there's a combination of these things. I just don't know the real answer. Sorry, Michael. All right. Any other general questions that you might have seen there, Jason? All right, here's one from Robert. What do you do with a stock that keeps getting away from you? The copper stock in question is A1M. So, Michelle,
let's have a look. Yeah, it's there's when a stock's getting away from you, one thing I sometimes do, I'll just buy half a position. If I'm looking at it keeps running, I think it should pause, but it's not pausing. I might just buy half a position or a third of the position. So if it just does keep going, at least I got something on board. If it pulls back, well then it's bought at a higher point, but it's only a partial position. So I'm trying to just have an each way play at it. Stock like A1M, so like buy signal might have been somewhere around mid-April. Now I was talking about copper stocks. Probably early April, there was we had some entry sort of potential going on there with some setups that where risk could have been managed with relatively tight stops, and then it's all run, and it's now become quite hard to get on those copper stocks if you hadn't been on board a few weeks ago. So using consolidations like we saw during mid-May, that can be a point where, again, maybe establishing a partial position. It's a really difficult situation for me to look at this now and say, look, where should I get in? Because it's just run so far, and we do know that markets always do consolidate at some point. Nothing to say it can't keep going vertical, but things that go vertical, they often come right back down as well. So from an asymmetric perspective, it also gets to a point where I say, look, I've just got to leave it. Just got to stand back and see what happens. That's probably where I'd be with this one at the moment.
All right. Okay. So obviously, let's start having a look at more stocks now. What do you think of LIT? Please have a look at LIT. So
LIT is a lithium ETF. It's an interesting one which I've been keeping an eye on. I think it's looking really interesting. Is it basing? Is this part of a basing formation? And I've been watching like some of those rare earth stocks like Pilbara and Iluka and Linus, and they're looking interesting as well. So it's all related sort of areas. This hasn't quite turned up yet. The moving averages look like they're getting. They look like they're on the way to turning higher. I like that we've had like a strong rally from the April low, and then we've got this sideways consolidation just along the moving averages. It looks like it's setting up to try and push higher again. There's certainly a case for saying, look, I could buy at current levels. So if I was keen on this and wanted to get in a little earlier, I could say, look, I could buy at current levels and put a stop loss. Maybe, look, really, an aggressive play would be a stop loss just probably 3% below the market. Or maybe even giving it 5%, see whether it can, if it does pull back, retest 100-day, go a touch lower, 5% could still keep this one in play. And it's very much asymmetric because you've got upside, like, well back to much higher levels. Related to that is the rare earth ETF, REMX. And this looks a little bit more advanced in that it's already breaking up to new highs. Moving averages are closer to crossing. This is where you find the likes of Iluka and Pilbara and so on. So I think it's an interesting space. I think these stocks are worth keeping a close eye on. Potential to get involved now. Likewise, there's nothing wrong with waiting for a little bit high to see whether the trends break up. You could give this one another couple of dollars before getting involved, but I think looking very interesting.
Okay, fantastic. Plenty of stocks here. RCE. Can we have a look at RCE?
Yeah, let's just see where this has come from. So it's been the doldrums for a good 3 years now. These pharmaceutical companies, they can be quite erratic with their price action. The potential's there for something to be going on. So we've gone from below the moving averages to above. The averages have crossed. Strong rally. And this is where I was saying, like with that copper stock earlier, where if something gets to the point where it's really just run so fast, you say, look, it's just not an asymmetric entry point. How do I manage my risk around this? Because you always have the possibility that you do get that deeper pullback towards the moving averages. So with this one now, I wouldn't be buying it at the moment. I'd want to see whether it stabilizes, because this stock has been prone to going up quickly, then coming straight back down. It's done it before, could do it again. That said, it could also stabilize here and then have another run to the upside. So it always comes down to, like, how do we manage risk, and when are the odds in our favor? So I don't want to buy it as it's weakening because it could keep weakening. So I'd be sort of seeing whether it can stabilise somewhere soon and start getting that sideways price action. From there, you potentially get a base, and then you could potentially get a break higher and have another run. So I'm really looking for stability, and then maybe buying the breakout if these moving averages come in and catch up, or if it's trading along the moving averages at some point, maybe it's buying it on the moving averages. So I want to see the price action develop a little bit more. But there's and if I got in early, I'd be letting it run and probably giving it at least till below the 100-day moving average to give it plenty of room to move around, because these ones can be pretty volatile. So giving it room to move around, hopefully staying on if there's something emerging, and hopefully it goes higher again. But yeah, it's always about managing that risk, having your exit points, and knowing where your potential entries are. And that's after probably more consolidation or maybe a breakout.
All right. What about AIS? 50 and EMAs the 50 has gone above the 100.
Yeah, certainly has. So I like it's got the makings of those of trends. So it's gone from below the averages to above the averages, have crossed. We've had that little sideways move back towards the averages. Now it's run again. So just looking at this, how would you play this one? So one possibility would be possibly it could be bought at current. It's like this is where these lower price stocks, just working out your risk on it. It's like it's a harder one to get, because you've got to think, like, where do I put the stop? Like, I like to put a stop below previous lows, but that's 34% below, and that's probably a touch below the 50-day moving average. That's a pretty wide stop to be going in with 35%. Otherwise, to have it close, you're kind of running in with at 10%, but it's a sort of stock that could easily come back 10% and chop around and rally again. So I like to keep the stops well back, but it's harder with this one given the extent of the rally. If I was in this one, I'm certainly staying in. I'm letting it run. In terms of an entry, I look at it. It does have the potential to kick higher again. Then it's like our earlier question. Like, I keep missing it. It keeps running. How do I get in? It's like the time to have probably gotten in was when it was like breaking out of this little sideways pattern. When was that? That was on Wednesday last week. That was probably the point to buy it, with a stop back below here. Now it's put on that little bit more. It's a bit harder. It's a harder one to manage risk around at the moment. I'd probably be inclined just to have to watch this and see whether we do get a bit more of a consolidation to have another entry point.
Fair enough. And then what do you think about Michael Hill stocks? Where's that looking like at the moment?
I can't remember the code for that one. Do you have that there, Ron?
No, I don't. Can we type it in? Should see if it's got an Australian.
That's it. MHJ.
Yeah.
Haven't seen this for a while, and this is why I haven't seen it for a while, because it's been in a downtrend. Look, this is one of the things I often say, is that most of the bad stuff happens below the moving averages, and that's what we've seen here. And consolidating below the moving averages is always when a stock is its most vulnerable, and it comes out with something negative and it gaps lower. It's like this can happen from higher levels, this can happen from above moving averages as well, but this is just the most vulnerable point for a stock. Look, if this wouldn't be in my portfolio now, because it's been below these declining moving averages for so long, it would have reached my risk point, and I would have cut it. What to do with it now? We can't give personal advice on this, of course. Everyone's got to make their own decision, but the vulnerability is that this keeps declining. So it's sort of like, I guess it's a bit of a what if. Like, what if the stock falls? So from where it is now, what if it falls another 45%. So a move down to around 25 cents, that's about another 45% decline. So what if that were to happen? Is that something which you can go, well, look, okay, I can live with that. If you just go, look, it's just horrible, I've had enough. Well, then I think you've got to consider cutting a loss now and getting out. The reason people don't take losses at this point is often because they go, well, look, if I sell now and this turns out to be the low and it starts going up, it'll be terrible. For me, what's worse is not that I might sell out at the low and it might go up. What's worse for me is that it might keep going down and I'm down 50% from where it is now, which isn't entirely possible. I'm not saying it will happen, but it certainly could happen. Stocks that gap down, presumably on high volume, there's an exodus from the stock. There's a chance that unraveling does continue. It's gapped lower because it's come out with a negative announcement. It's usually not a sign of a bottom. These things can continue to unravel. So for me, I'd be protecting the capital which I still have on the table, and moving it on, and certainly not looking to buy it at this point in time either.
Yeah, it's a good answer, Jason, because at the end of the day, obviously no one knows the future of Michael Hill fundamentally unless you ring up Michael Hill and ask them. Maybe they'll be able to tell you, because as shareholders, if you're a shareholder, you're more than happy to ring up the investor centers of companies and ask them these questions, right? But unfortunately, we can't know the future. It's just a stock on the decline, and it's not a pretty one to add to your portfolio from our point of view right now, right? So from a technical analysis point of view, obviously you'd have to work out what you want to do with that stock if you're currently holding it. So yeah.
So
all right.
I want to own stocks which are on this side of the moving average, where you can see the cursor. I want to own stocks from on this side of the moving averages. When they flip to the downside of the moving averages, I might be giving them a little bit of time if they're still above a trailing stop. But once they're below those moving averages, they're very much in the departure lounge. And it's just a matter of like when they get moved on, unless they can quickly get themselves back above moving averages. I don't want to persist with a stock whilst it's below these averages, because whilst many stocks a stock will invariably bottom out when it's below the moving averages, but we don't know when that bottoming process could be. If you'd been holding on to Michael Hill since the start of 2023, we're now almost 18 months of waiting for a low to form. Who knows where it's going to form, if it forms? So as I say, it's a vulnerable time and a dangerous time to be owning a stock and holding a stock below declining moving averages.
All right, let's have a look at WDS, please.
So it'll be Woodside. Yeah, well, there we go, below the declining moving averages. It's not a buy from my perspective. Oil's been an interesting one, because oil's looked like it might have been trying to engage in an early stages of an upward trend, but it's been faltering over the last 2 or 3 weeks. Could Woodside bottom at around current levels? It's like, well, it could, and this is what keeps people in these stocks longer than they probably should. I'm just looking at the weekly to see whether it can give me some clues on support. Like, could you say, I'm just going to draw something in? Yeah, look, it's drawing. No, it's drawing too much of a long bow there. Yeah, it's for me. I'd remove it from my portfolio. I'd remove it from my portfolio because it's tracking below these declining moving averages. Everything we just spoke about with Michael Hill. This could bottom at these current levels. It could base and start trending higher. Absolutely, it could happen. But it comes down to, what if it doesn't? What if it goes from $28 and it's down at $23? And then you're going to be, a lot of people will be thinking, oh, well, I should have sold at 28. So it's now at 23. I'll sell if it gets back to 28. But that may not happen anytime soon. It could go from 23 to 18. and then you keep chasing your tail. Well, I don't want to sell now because it's fallen too far. I better just hang on for the long term. And that Woodside is a big company which is probably not going anywhere in terms of holding onto like a smaller company. Smaller companies go out of business. Woodside is probably at the size where that's not likely anytime soon. But still, it could still languish for years and do nothing. So I'd be moving on sooner rather than later. And if it happens to start going up, well, there's nothing to say you can't come back in and buy it later on at a higher level. Sure, you've got to pay more money to get back in. It's a bit frustrating, but I think we've got a number one criteria has to be protect capital. It's not hold and hope our capital comes back. We've got to protect the capital we have. If something doesn't look right, just do the hard thing, I think, and move it on and look for opportunities elsewhere. And if it comes back, well, it comes back. But the ones that come back aren't the ones that do the damage. It's the ones that don't come back, which can really be the lead weight around your portfolio and really ruin your capital. So I'm always moving on stocks in this situation.
Yeah. All right. NEU.
Yeah. It looks it's certainly one I'd be holding if I had it. And actually, as a motion trader stock, I'm quite sure. It's an example of a stock which, like we're just talking about, people worry that, what if I sell and it goes back up? Well, this happened with this one with a motion trader exit. It hit the trailing stop, I think, somewhere around September last year. So I think it just came back, just clipped the trailing stop, and then within a month or so was off and away again. And I think there might have been a new entry point just as it was getting back to those previous highs. So these things will happen, and there's no way around it. It's going to happen unless you just buy and hold and never sell. But then you're also going to have stocks which completely come apart as well. So but looking at it now, I think the upward trend's in place. It's had a consolidation. If I owned it, my trailing stop would be probably still back around maybe $15, $16. I'd have to have a look at the calculation, but I'd be giving it a wide enough room to move to see off this pullback. If I was thinking of buying it, well, look, maybe this is to buy the dip. It's had the pullback to the moving averages. If I wanted to buy it for some reason, maybe I could get in at current levels, put a stop loss below the May low. So it's all about always keep coming back to risk, managing risk. We can really clearly see how we can manage risk in this one. And if the upward trend resumes and we get that more momentum to the top side, well, great. Can be in at a good level. If you're already in, as I say, it's one I'd be holding.
Okay. All right. Maybe this is a good question just to talk about this stock here, actually. Do you buy a breakout stock previous day on a down day, especially on Friday? So I'm assuming is if you buy a breakout stock on the day or on a down day, I guess.
I'm not too bothered by the day of the week, so we can address that part first. So be it a Friday or a Monday, I don't really care because I'm not a swing trader. I'm not looking at what might happen over the next couple of weeks. I'm focused more on what could happen over maybe the next year or two. So not too worried by the day of the week. If I get a breakout and then the stock opens lower the next day, it'll depend on the individual stock, on the overall setup, on the overall market conditions. If we're in a period where there's some uncertainty in the market, just like I'm looking at the ASX 200 now and saying, look, could this pull back in the range? If I get a breakout, opens lower the next day, maybe I can just watch it for a day or two and say, well, look, if it breaks above that previous high from a day or two ago, maybe I'll get in then. But if it keeps pulling back, well, then I can just be patient with it. I don't need to get involved now. So my response to that could vary. But I think there's certainly a case for, if you're looking at something, then it gets at that lower opening than you were expecting. Yeah, maybe it is okay to, rather than say, look, I can get it a little bit cheaper. That could be the play too. But it's also nothing wrong with saying, look, okay, I just use this as an opportunity to watch it for a couple of days, because there's a bit of uncertainty generally for whatever reason. And sometimes that saves you from getting into a stock which then just continues to gradually unravel or pull back.
Okay, what about TWE then? Let's have a look at TWE.
Well, this is an interesting point. It's I like the rally, and then the pullback looks like it's part of a corrective pullback at this point. So it's stabilizing, probably where I'd want it to stabilize. Just put the Fibonacci's on this one, because it looks like it fits that Fibonacci profile. And you can see it's pulled back right into the midpoint of the Fibonacci. So using the low to the high. So it's a proportional looking pullback. So that's all good. So if I'd bought this a little bit early, if I'd bought it on the breakout, even if I was a little bit in the red, I'd still be holding this with my trailing stop. If I was looking to buy it, like the amber flag, not probably the red flag at the moment, but the amber flag is just consolidating below these moving averages, which are rolling over. This will happen sometimes in the early stages of an uptrend. It will come back, have an excursion below the averages, and then be back above it. But I wouldn't want to give it much more leeway. A break below the May low, that would be enough for me to say, look, this might not be working just now. If somebody really liked the idea of it, it's a low risk entry point in that it can be bought at current levels. A stop could be just below the May low, so it's only a 4 to 5% stop, and then you look where it could go. It's very much asymmetric, but it really is. It's getting borderline on it just being. It's not a pullback to the moving average; it's a pullback below the moving averages. So I'd probably prefer not to make that play, although it is one which you can sort of justify based around the risk. It's a clear risk cutting point. So yeah, look, I think this has a potential to rally from here, but key point now, it's got to hold the recent low, break below the recent low, then it does run the risk of that whole rally from the start of the year unraveling.
Okay, NXL.
So I spoke about this in my strategy session video on Friday, and I was talking about it as a buy. I was talking about it this is on Friday here. I said, look, we had a great setup, and this is why I've got this all drawn in. I said, because it'd been a motion trader signal. It was a motion trader signal. I can't remember exactly where it was now, but yeah, I think it might have been December. So it's motion trader signal in December. And then what I do in the strategy session videos each Friday is I'll talk about a couple of stocks, a couple of recent signals, and discuss them when they're looking interesting. I was talking about this range that the price had been in, come back to the moving averages, consolidating on the rising moving averages, just broke higher last week, and it was like, well, look, this is another entry point to this stock. And then on Monday, gapped open. So it just shows you've got to be. It really does pay to be watching the price action and understanding in terms of finding some of these opportunities, because it was low risk in that, not just saying it's a low risk stock, but the risk could be managed. So that's what I mean by low risk, in that a stop just below the 50-day moving average. So it's a relatively small amount of percentage risk for upside. As to what to do now, it's like, well, it's now broken higher. It's now stretched above these averages. I don't know that. I'm not sure it's an asymmetric entry point now. It's certainly got lots of upside potential where you see where it's come from, and there's a high volume move to the upside. I'd probably just prefer to just see if it consolidates maybe for a week or two, just get some sort of even if it's just a little bit of a sideways action, just let those moving averages catch up a bit, a little bit of a pause. Maybe that provides another entry point. But if I had it, definitely be keeping it.
Okay. Do AGE, please.
So this will be an uranium play, and yeah, it's the overall structure certainly has potential. Can probably put in maybe some support somewhere just in around 5 cents. Where's the current price? It's just starting to I like that nice strong move earlier in the month. Had that classic sideways pullback to the moving averages, break to the top side again. So if someone was keen on this stock, yeah, it could be bought at current levels. The stop could be just like 14% lower. You could use the May low, or I think that'd be the May low, or the 17, I think the 16th or the 17th of May low as a reference point for the exit, so a little bit below that. So see if it does. If it can gain momentum from here, that's a nice, relatively low risk entry into what can be a volatile stock. There's further support below there, but it starts percentage-wise, starts getting a little bit far away to manage the risk. Yeah, I think this certainly has some upside potential, as does the uranium space generally. So overall structure, yeah, interesting.
Okay, I was just wondering if these are similar stocks. SRZ, are these all uranium plays? SRZ and TG1? No.
Yeah, it's such a low price stock. It's a 2 cent stock. It's too hard. It's like just even to put your stop below the recent low, you're looking at 30% below the 100-day moving average. You're looking at 40%. These low price ones, and people are attracted to them because the potential to double and to triple is always there if the market gets excited about them. But it's also like, how do you manage your risk around them? So like I just look at the chart, take the numbers off it, and where the cursor is, that's where I'm thinking I'd like to manage risk around this. But it's 40% lower, so it's quite a big chunk. Maybe the play I'd prefer would be if it pulled back towards the averages and went sideways a bit. Maybe I could buy it then on the averages, and then the stop loss isn't quite as far, or alternatively buy early on the breakout, and then again I can put the stop loss within the range. So sometimes you can get into these low price stocks, and get a lot of potential leverage through that low price, and also be able to manage the risk. But once they go on a bit of a run, it's like finding your exit point to manage your risk. It can get a bit tricky. So for now, I'd probably be leaving this one. Although if I did get in at a lower level, yeah, by all means, let it run, see if something happens. Most of the time, nothing happens except it just goes all the way back down to where you got in. That's what happens with these low price stocks. But that's not a reason not to look at them, because you only need one or two that you move the decimal point one place to the right and it's gone up tenfold, and it pays for having a go at 20 or 30 that didn't work. So yeah, if you like this area, by all means look at it. Look at your chart structure and work out your risk management points about where you could place an exit.
All right, and I think I might finish up today, and there's quite a few in there, so sorry if we didn't get to them today. We'll definitely get into them in future sessions, right? But I think I might just finish off with this question, and we can relate it to the charts that that they've mentioned here, and it's around, I guess, corporate actions. So it's the question starts as from Soxy. What's your opinion on mergers and takeovers? So I guess what then the clarity, to elaborate on the question is, how would you trade around them if a company was, it was involved in a merger or a takeover? And then they've actually talked of what stocks they recently bought, which was TED. Let's have a look at TED. How would you deal with that, Jason? What's your opinion? How would you trade around that?
What's the stock
Ted,
code?
TED, Ted?
TED.
It doesn't look like an Australian or US stock. Maybe let's try MRM. They've got a few there. MRM.
Well, I know a bit about this one because I've got some shares in this myself. And the way I've been playing it is to just hold it. So I'd held this one for a while. My entry point was, I don't know, it was way back. It was over a year ago, a couple of years ago maybe. So it's done well. It's up maybe a couple of 100%. Not sure offhand. This is where the takeover occurs here, where the price gaps up. I've just held it through this period, and I think the directors have recommended and everything, and it appears that it will just go through in due course. And I'll get should that happen, I'll just get whatever the price is. It's 265 or something maybe. I'm not sure offhand. So that's typically the way I do it. If I'm in the company being where there's a takeover offer, I'll usually just hold it and let it play out. But there's always a risk that a takeover fails and then the stock just gaps lower. So I think that happened I think it happened in a lithium play. I think it was Lintown. So this is the risk with takeovers. So I think, like, I don't know this closely. It's just through just reading stuff. Didn't have shares in it, but there was a takeover play for Lintown, and then it fell over, and you can see the price. It just gapped down. So that's the risk when you're in a takeover situation. So you want to get an idea of do you think it's likely it's going to go through? Because if the takeover gets pulled, well, then you've got the downside in the share price. So it's something to be aware of as a risk. So if it looks like your upside from the takeover is like a couple of percent, sometimes I'd think of, and it's unclear that it's going to go through. Sometimes I might sell on market and just lock it up rather than risk this scenario with Lintown. MRM, I think it looks like it seems to me likely that it's going to go through. So I just wait and let it go through. But it's something I'm looking at. If the share price was to start selling off unexpectedly and without a reason I could identify, well, then I might start getting concerned. Look, is something going wrong here? Is this about to fall over? Maybe I would then go and sell on market. But for the most part, it's hold and let it take its course.
Okay. Well, let's have a quick look at AWC to finish off on that question then. This is another takeover, I think. It's another takeover play at some point.
Right. Okay. It's look, without knowing any of the details in this one, I'd just be holding and letting it run. The share prices continue moving up. Like, another possibility with these takeovers is that the takeover price gets increased, or there's a competing bid, and sometimes the price can go considerably above where it starts the takeover process. So that's why it's like, well, I'll stay in unless there's a reason to sell and get out early, or I want to, it's going to take 3 months for the takeover to complete, and it's pretty close to where the takeover price is, and there's other opportunities I want to pursue. Maybe I'd sell at market then and just forego a little bit of the upside to put the money into something else. If there was no urgent need for the money, I'd just I'll let it run. Just being mindful of that downside scenario risk, but generally let it run.
Okay, fantastic. Actually, the other ticker was red, not Ted. Red.
It's a gold stock, and they're merging with another gold stock. I think this is the one which is doing the acquiring. Can't remember the stock they're teaming up with. But yeah, look, why would you sell this one? It's in an upward trend. Gold price is going up. It's there's no reason to say, look, this is going to be the high. It's like let if something's working, just let it keep working, and because some of them work for a long time. So yeah, for me with this one, let the trend do what it does.
Let the trend be your friend. So I think we will finish up on that for today. Thanks, Jason. Thank you all for your questions. Thank you very much. Now, don't forget, if you're wanting to save some money with brokerage, you can always come to Self Wealth. If you're trading with banks or any other of those type of brokers, then we're here to save you money, right? If you want to check out what Jason does, then you can go over to motiontrader.com.au. And have a trial of his service as well. All right. If you've got any questions for me throughout the week around Self-Wealth, you can always send us an email to support@selfwealth.com.au and just attention it to Roger and it'll get to me as well. All right. A lot of the times, we're doing these shows, Jason. We don't know if they're trading with Self-Wealth or if they're, using your service. But please, we do appreciate if you want to know more, then ask away, ask questions about the service, and maybe we'll, maybe it'll help you in future. Right. So anyway, thanks again, Jason. Thanks for today, and thanks everyone else.
Yeah, thanks, Rog. That's been fun. Great questions, everyone. And yeah, we can't do next week, just so you all know. I've got something on which I need to do, and I can't not do. So we're back in 2 weeks. Back in 2 weeks for another show. But I've got my weekly strategy sessions on Friday still for those who would like an update in the interim.
Yeah, thanks for reminding me. All right, guys. Thanks, everyone, and have a good day, and we'll speak to you soon. Bye-bye.